0.5%. Barb, your thoughts in general here on the market field position, because there's two ways, I think, to characterize what's been happening. One is, just another bear market rally. We've seen a couple of these double-digit rebounds when the market got oversold and sentiment got too negative, and they have always failed before getting too far and before breaking the downtrend. On the other hand, people say bear markets have a knack for bottoming in October, year-end strength after midterm elections, earnings perhaps not as bad as feared. Either one of those cases make more sense to you?
Yeah, I know. I think, the reflex, of course, because of all the PTSD from this year, is to think this is another bear market rally. And it very well may be. People are saying, is this a repeat of the summer, where we went up for 2 months and had good returns just to return back to the lows again. I think there's a big difference now, though. We've had a lot more economic data points. And obviously the CPI number and the PPI number that came in the last week excited this most recent rally. Because what you're seeing is wholesale prices, consumer prices rolling over. The consumer is weakening. We're seeing that in the savings rate, which is now below trend at 3%. You're seeing a big increase in credit being used. And of course, let's not ignore the impact of everybody seeing their stock and bond portfolios and their crypto. And that tends to be a lot of younger people, involved as well. So things are weakening. And I think that the question here for the market is we've got the CPI, a PPI, and a PCE number coming up in early December. What's that going to be? Earnings are now done, so we pretty much know what's going on there. So I think the market will tread water here. I don't think we see a return to the bear market lows until we look at the first quarter and have the company commentary on what's going on. Fourth quarter should still be okay. We're already into almost late November. And what they see then, because there is going to be much more of a bite. It's that lagged effect we're all talking about in terms of the Fed hikes.
Yeah, there absolutely is a lot of focus on that January reporting season. It might be when companies kind of turn their sights to what's to come for the next year and maybe have to re-guide investors. One of the themes, though, aside from just the overall index downtrend, has been that the average stock has outperformed the big cap indexes. And you've seen some resilience in certain pockets of the market. It would seem almost to reward a stock by stock approach more than in prior years have. Have you found that to be the case, that it's easier to find ideas that are worth acting on, and where?
Well, I don't think it's easier, but I think that is exactly the approach. And you've done a great job pointing out in the equal weighted S&P what the real performance is. Because obviously the big tech has gotten killed for the reasons we know very well: overcrowded valuation, et cetera. But I think, there are still pockets where you look in. And that's also when things get crushed, like you had Meta a few weeks ago. But you look in healthcare. There's a good defensive play where things are not wildly expensive, because right now that is a problem. Where do you look? Value stocks are up, utilities are up, the staples are up, and they're great, and you should hold them for now, but probably not a lot of upside from here. So I think stock picking is it right now, and you've got to look, but you can find them. But I don't think it's by sector at this moment.
Yeah, fair enough. Definitely a change from the 5 stocks running the whole S&P as we had going into the highs of last year.